morning, everyone. Morning. So I know all of you have had some very grilling Saturdays over the last 2 or 3 months, uh, you know, and I think this is the last of the Saturdays that you're going to have that. But before we do, I think we'll, I know you. I was talking with Naresh Bhai, and you've looked at all the differences between the commas and the semicolons and the and the thus as well now in all the articles of the tax treaty. So we said we'll probably drop the ball today for the next 1.5 hour, 45 minutes, and just step back and say that okay, uh, there are two parts to it as what we do as tax professionals. One is we have the law and we interpret that law. I mean that's what you've done all these few Saturdays, and you looked at every article and said, okay, what does it say and how do we apply this? How do we interpret this in different client situations and so on and so forth. There's the other part of what we as tax professionals should focus on or occasionally start focusing on, that is the law itself correct? Is that law what we have on our hands the right law? Because there is a purpose of the law. And what is the purpose of the law? The purpose of the law is in the context of where the country, where the economy stands, and it is not just meant to be out there just to be applied in a particular way, because every law is not static. I mean, what is good in the 18th century wasn't good in the 19th century, is certainly not even thought of in the 20th and the 21st century. So if that is the way law changes and law evolves, at every sort of some point in time, we need to step back and say, okay, this is the right interpretation of this law, but is the law right in the first place? Is this right in the context of the current economic challenges, the current economic situations that exist, the stage of our country, the industries that we are focusing on, and so on and so forth. And that's what we'll probably try and do today, to say that okay, what law we had, are we re-looking at that law? We'll also try and do some crystal ball gazing with the budget and everything around, as to what the law can be or what the law will change. Not only in India, you're seeing this thought process across the world, where every country is trying to see what are the changes in the tax laws that we bring in, and so on and so forth. So uh, let's sort of, as I said, drop the ball a bit, not get too complex with the commas and the semicolons and the ands and the thus, and those are very important. I do that all my day and all my life, and I love to do it. But for the time being, next couple of hours, let's just step back and say, okay, can we define the law? Can we say what is the right law, or at least understand what is the law that we will have going forward? So that's the sort of broad context that I wanted to set in before we get into the two topics on that's allocated to me. And I know you've had some bits of it being discussed. Naresh Bhai told me things he spoke on BEPS, etc. So I know that you've had a few discussions, and as I said, we'll not approach it from the perspective of interpreting it. We'll approach it from the perspective of trying to understand the logic and the rationale that went behind it, so that whenever we interpret the law that comes out of it, we are mindful of that logic, we are mindful of that rationale, and you cannot interpret the law without having regard to the rationale. So every time with the budget, you see this explanatory memorandum coming in, the circular being issued. What is the purpose of that? The purpose is to say that this is what we as the parliament thought in putting this act or the section in place, and therefore please interpret it in that light. Don't interpret it to have a different meaning, and so on and so forth. So everything that we probably just spend for the next half an hour at least will be focused around saying what is the rationale, why the changes are coming, and what will be then. We'll also get into, as you said, some crystal ball gazing and saying, okay, what is the future likely to be, and in an Indian context, how this will get translated into for all of us, because we have all our clients and our employers being in India, and we need to focus on that. And of course, the last bit we'll also talk about the commas and ands and thus. We can't do that as a chartered accountant; it runs through our blood. We'll talk about the GAR provisions, which are already there in the law. Again, a little more at a macro level, because each of these items, if you need, will take 2 hours to discuss just the basic provisions of that law, each of these items that we'll deal with here. And therefore, we probably don't have that much time, so we'll probably only be scratching the surface today. But at least the idea would be to try and see that we have a broader perspective around each of these regimes. I'll probably put my coat off. It's a little warm here, but sorry. Yeah. Okay, so let's start with the base erosion and profit shifting, or BEPS. Uh, Something in the field of policy first, nothing to do with the law. So it's a new paradigm in the way taxes will get applied or will get levied in the world. So it's not something which is what is given or the status quo. It is completely new. So we'll look at what is all about, what are the outcomes and challenges in implementing them as we go along, what are the things that we will face, what is it that the clients will face, and then we'll look at a few of the specific action plans. I mean, of course, some of them have been dealt with, so I'll probably try and rush it up, and please guide me if you think these are things that we've already addressed and you probably know it, and then we'll move faster on those bits. So how did this all begin with? Where did this start with? Why did somebody think of changing the law? And this dates back to 2007, 2008, given the global recession, where most of the governments had huge deficits, both on the fiscal, current account, and so on and so forth. And therefore, the focus of the policymakers or the parliamentarians of each of these governments went on to say that how do we get maximum revenues? And one of the biggest revenues for any government is tax revenues, right? So they set upon and said that if tax revenues is something which is an important top line for us as a government, are we getting our due share, our fair share of taxes? Or are we having taxpayers who plan around their affairs in a manner such that we do not get our fair share of taxes? We've had that debates in the past, and not sure all of you know it, but there's always been the debate about tax planning, tax avoidance, tax evasion, and the fourth thing came up. So I think this three probably everyone knows. The fourth thing came up in those days in 2008, 2009, and that was not about any of these three things, but it was about tax morality. So for the first time, we said that, okay, it's not that the question was, are you paying the right taxes as required under the law? The question really was, are you paying the fair share of taxes that you as a corporate citizen or an individual taxpayer or a citizen of a country should be paying to get or be a citizen of a country? So it's no longer about, are you paying as per the law? You may be paying as per the law, but is that a fair share or reasonable share that you should be contributing to the coffers of the government, so that the government is in a position to provide all the services to its citizens, and so on and so forth. So the whole discussion moved around away from the historical things of tax planning, evasion, avoidance, etc., to tax morality. And even though if you paid the right share of taxes, you would be shamed in the public. So anybody can recollect examples of people who've been shamed in the public for on these grounds? Starbucks, yeah. Some of the best brands in the world: Google, Apple, Starbucks, Microsoft, all of them. Some of the best brands. And one can say, were they paying the right amount of taxes as per the law? Were they in compliance with the law? I think the answer was a clear yes. They were all in compliance with the law. But the issue was that they were paying so little taxes after having planned with people, all of you around, that the government ended up saying that, okay, we understand you have so much, but you making billions of dollars, but you're contributing a few millions to our coffers. And that's not the tax that we are expecting the normal citizen of this country to pay. And what did it have as an impact? So somebody will say, fine, that's your law, you put the law, and I'm paying as per your law, tell me where am I wrong? That's the natural question that somebody will put up. But that's not what happened. When this backlash happened against these large corporates, there was a huge media trial of each of these corporates, and which meant that people in the UK, for example, where Starbucks was attacked, said, we'll stop visiting Starbucks. because they are not the right corporate citizen of this country. If they want to be in this country, they better pay for the services and etc. that are getting used in this country, you know. And therefore, they said that okay, we as the citizens of UK will stop going to Starbucks, which meant that Starbucks had a huge dip in their revenues, and that was it was critical for them to say, okay, stand up and say, okay, while the tax guys are right in what they're saying, but that's not what business is asking now. The business needs have changed. The business is asking that we need to pay a fair share of taxes. So most of these large CFOs and heads of these companies were called upon by the parliaments of each of these countries, and in the parliament committees they were questioned. And if you want to be, you're more interested in knowing how that happened and how they were grilled completely, more than the CBI possibly grills anybody, you can go onto YouTube, and there are many videos of some of these tax committee meetings of the parliaments with these key heads of these organizations, and you can see it for yourself. So stepping back, the purpose of the government to attack was not on the law, but on the principles of morality. What is fair, what is reasonable for you as a corporate citizen or as an individual to pay in the country. And they found out that it is not that it is just about our coffers not being met. It is also about that the tax not being paid by is largely not being paid by these multinational organizations, so who operate in multiple jurisdictions and have the ability to park their profits in jurisdictions which are low tax jurisdictions, and so on and so forth, right? And many a times they found out that some of this things have arisen not because they wanted to do it wrong, but also because the laws that we have put in place, the systems that we have put in place to collect taxes or recover taxes, are not adequate enough or not focused on this issue. So you've already always had these tax treaties, and you've learned a hell lot of it about in the last 2-3 months. What is the main purpose of a tax treaty? What does the heading say? DTAA. So what does it read like? Double taxation avoidance. Yeah. So that was always the focus, that you want to avoid double taxation. But what that treaty in place led to was no taxation, or less than the normal taxation, and that is what the difference came about, and said, okay, we've had this historical focus on double taxation or avoiding double taxation. We also need to at the same time make sure that people pay at least one level of taxation. There is no situation where people pay no taxation or zero taxation. Now, all of this, any taxation that has to be paid or not to be paid, or any incentive that you get, or a Mauritius gives you zero tax rate on anything, is because of whom? How are you able to take advantage of a Mauritius or an Ireland or a Singapore or wherever you go into Netherlands, BVI, so on and so forth? Who enables you to do that? The government policies, yeah. The government themselves makes the laws, yeah. So it's not about you going and making a law there, right, as a corporate citizen or a corporate taxpayer. So it is the government who themselves had policies which encouraged people to come and set up shop in their countries and take advantage of the incentives, benefits, and so on and so forth in different ways. Okay, so multiple ways of doing it. We'll not get into the details of all of that. So with that, they realize that it is all our doing. It is nobody else's doing. It is all our doing, because we have over the period of time encouraged all of this through innovative tax policies, tax regimes, patent box, holding companies, so on and so forth. And we've led to this conclusion and results that ultimately people do not pay their fair share of taxes. And they therefore came back together. The G20 was the first body of the 20 most strategically important countries of the world, which came together and said, okay, we need to stop this. We need to act against this. And because our deficits are ballooning, so that's one reason, but there were several other issues or reasons why we should stop this. And therefore they came together and said, okay, as a tax body, we'll ask the OECD to take this forward and frame the right set of rules or policies that should be brought in place in the field of international trade and commerce, so that we ensure that people not only get away with double non-taxation, which is, I mean, double taxation, because that shouldn't happen as well. You shouldn't be having double taxation of the same income. But equally, people are not getting away with zero taxation or less than normal taxation. I mean, so that's the clear focus of getting this whole new era or new paradigm of tax policy that has been put in place. Uh, and as they went into the details, they found that people were trying to evade or have less than normal taxation by putting profits in jurisdictions or parking profits in jurisdictions without there being substantial business activities in this jurisdiction. So if you have a Mauritius holding company which invests into shares of an Indian company, there's nobody in Mauritius of that holding company. The decision makers are all in their respective countries in the US, UK, Europe, wherever else they are. They're sitting there, the funds are there. There's nobody in the Mauritius except a post box address. And they said if that is the level at which they operate in the Mauritius, then they should really not be tax residents of Mauritius, because they have no presence in Mauritius. They have no activities in Mauritius. And if that is so, then they should not be getting the benefits of the India-Mauritius tax treaty, and therefore whatever capital gains they make in India should be brought to tax. Just as an example, not all cases like that, but as this is the basis of what they concluded and reached. And that's how they said that two things needs to be done. One is everybody needs to not have any of these preferential tax regimes which reduces the tax down to zero or virtually zero. And secondly, we need to ensure that the profits are shown in the entities or in the jurisdictions where the relevant business activity is taking place. So there has to be a nexus between the profits and the business activity, and you need to make sure that the profits are shown in the place where the business activity in reality is taking place, because that you can't beat. Certainly, you can say that the accounting will show profits in one country or one jurisdiction or the other jurisdiction, but you cannot say that the profits are the horse of the underlying business activity. I mean, the business activity has to happen somewhere to lead to profits in the for the organization or the company, and that's how they try to say that we'll match these two things and try to make sure that people pay that one single level of taxation that they're supposed to pay. So again, I mean, I'll not go through all of this, but these are some of the startling statistics that they found out, that if you see the profit rates of MNE, the multinational affiliates in the low tax countries, so where the tax rates were much lower than the 35-40% average rate that prevails in most of the developed countries, they said that the tax profit percentage or the profitability that they showed in those low tax countries was almost twice what they showed in the higher tax countries, which is clear that the purpose was to show higher profits in these countries and pay lower tax and not be subjected to the higher tax in the in the developed jurisdictions. So these are some startling statistics that they found out over the last 8-10 years of study that they did at that time, compared to somebody who's only within the domestic operation, some entity which is operating only in India, an Indian entity, for example, right? The profit that entity made was much higher than the profits that an MNC in the same business will make. Now, typically, you will never have that if the entities are in the same sector or the same industry, they'll make more or less same profits over a period of time. Yeah, so long as the brands and everything is comparable, etc., etc. But they found out that despite all those comparisons being there, the MNCs were able to show much lower profits in that country as compared to somebody who is only within that country. Because if you're only within that country, you don't have the ability to park your profits in another country. Whereas an MNC who operates in multiple jurisdictions has the ability to say, okay, we'll earn some profit here, but we'll repatriate royalties out of it and take the monies out and show very less profits here. Because a royalty to a group entity is still a profit of the group, but it gets reduced when you compute your net income in the domestic country. So therefore, these are the ways in which people try to work around it. And as I said, I'll not go through all of this. Different ways, royalties, by capital financing, you put more debt into a country and take interest out, which will reduce the taxable profits in that country because interest is a deductible expenditure, and so on and so forth. So multiple ways in which they tried to work around this, and they found out all of this and said, okay, these are the things that we need to attack and get into. So one was, of course, the objective of saying that, okay, we have this as an objective only to increase our tax revenue collections as a government. But is that the only objective? Was that the only desired results? And certainly the answer wouldn't be yes. If you ask the politician, the answer is only that yes, we'll try to increase the revenues and pass it on and do all these things, populist and so on and so forth. But if you go back and say from an economic perspective, that is that the only objective? And certainly not. Is there, if there is less than normal taxation, or there is discrimination in which a domestic entity or a MNC pays tax, then is that worth for the economy? Because then you are not having a same competitive force. At some point in time, the MNCs will start getting so richer and richer, and they'll be able to control the market and lead to monopolistic situations, which is not what you want as an economy, because you want fair competition in the economy between companies in the same sector. So they looked at all of this and said, which are the forms of tax planning or tax tools that they are deploying to reduce the profits. So transfer mispricing, as I say it, your intangibles are located in low tax jurisdictions. So you have in jurisdictions where you earn royalty income from other locations, but it's taxed very thinly or at a very low rate. High debt funding, putting more debt, getting interest deductions, TT shopping, setting up entities in jurisdictions where you have no substance and start availing TT network of those jurisdictions, and so on and so forth. PE avoidance, preferential tax regimes being used like in Mauritius, Singapore, BVI, Bahamas, so on and so forth. So multiple ways in which they did that. And clearly they found out that one of the key issues out of this is it was completely anti-competitive. It led to situations where same company in the same sector earning the same set of profits eventually at a consolidated level was paying much higher tax, and MNC was paying much lower tax than a domestic entity just paying a much higher tax, and therefore the domestic entity had the much higher ability to invest and make their products more competitive, and even over a period of time started getting market share over the domestic entity. So it's clearly anti-competitive within that country. For the government, it meant a higher fiscal deficit and so on and so forth. Variety of things where it didn't work well. So purely tax revenue collection is not the only objective of this whole regime. It is also has an economic objective for that. So what is it all about? What will it lead to? What will come out of this? So we've seen the cause why they did that. And the ability to avoid this tax planning, etc. Also, the other thing that had happened is that business models had changed over a period of time. So if you see the advent of technology, you really don't need to start having physical presence in each country to do business there. And with that change in business model, you also needed to respond to say, okay, is my PE, which is based purely on physical presence, because a permanent establishment which leads you to taxation in the source country is only based on physical presence. Now, should that be the right parameter where by having a website and I'm virtually in this country? I don't need to be sending my employees here, because I can have my website being accessed by the citizens of this country, and I do business as good as anybody in this country physically being there. You can show your product over a video, talk over somebody on a video phone. You don't need to be here in this country, right? So that's the other purpose, to say that if digital technology, cloud computing, etc. is coming this way, how do we change the way in which we tax it? Because otherwise, all these servers, etc. can be put in one location in Bahamas, and they reach out to the whole world. Bahamas taxes you zero on their tax on the profit that you make there, and all the things that you make everywhere else is not taxed because you don't have any physical presence in that country, right? So even the change in the business model required a response, and that response was not by saying we'll aggressively interpret the law to say even if you're not present in this country, you are a PE, because the PE definition only says you are a PE if you are present with a fixed presence in this for a fairly long period of time, and so on and so forth, right? So that's what Indian authorities do, right? Because they just go and say, okay, we want to tax you, so we'll now interpret the law in this particular manner, and that's not the right way of doing it. So you needed to respond to a business change or a model change that was happening, and at the same time, you want to make sure that there is no arbitrary responses to that whole thing. Because if you don't have a policy response, you will have tax administrations in all the countries feeling the pinch, getting frustrated, and saying, you should be taxed because you are getting a material profit out of our country. You are selling to our people in India and so on and so forth, and you should be taxed. And you're virtually operating in the country. You are having presence, technologically in a virtual manner. You are in this country. It doesn't matter you are physically present or not. So we will start taxing you the way we want it. Now that would have been a completely arbitrary response by each. And imagine if each 200 countries of the world were to have done that, you would have had a situation where there would have been a chaos. There would have been chaos because one guy will start taxing in a particular way. 5 days in India, you are a P. Somebody will say 10 days in India, you are a P. Somebody will say your website in India, you are a P. Your server in India, you are a P. You would have had no end to that, because everybody would have gone about shooting the way they wanted, right? So they said that we can't have an arbitrary response unilaterally by each country. We needed all of us to get together and come up with a single coherent response, a common response by all, so that it becomes a standard norm that is followed by all the countries, right? So that's the whole other purpose of getting together, because tax policy per se is the right of every country. India as a sovereign nation has the right to decide what its tax law should be. It is not to be dictated by anybody else to say what your tax law should be, right? And so is every other country. But if you want to have a common uniform approach and be with the world, you need to be in line with the best practices, the benchmarks that are set around. And the idea was to set up a benchmark on what is that minimum trigger you need to cross to create taxation rights for that country for the profits or the business that is being carried out in that country. So clearly, they did not want to, the downsides, if this was not to be done, as we've written here, is basically you'd have had unilateral action and chaos, and that was to be avoided by having a common approach. So what are the solutions that they worked out? They said, we want to have an international standard of how everybody approaches this. We don't want everybody to do this, so it's a coherent international standard where everybody tries to adopt the same principles so that there is clarity and certainty around how people will get taxed. You don't want an arbitrary situation. The important thing that they came up with, and which is always spoken about, is that substance will rule over form. So just because you have an entity, it doesn't mean that you are a tax resident of the country unless you have substance or commercial reasons of being in that jurisdiction or setting up an entity or having a particular transaction for royalty or interest or whatever it is, right? So unless you have substance which is driven by the commercial need to do that, right, you will not be, or the structure that you've put in place will not be looked up will be accepted, and you will be looked through that structure and said that if this was not there, what would have been your tax treatment. So the focus clearly went on substance, and at the same time to make sure that all that is needed for the tax authorities to determine how the taxation should apply, there was a need for transparency. That you can't hide data of what is happening in the other jurisdictions and so on and so forth, and you have to make full disclosures of everything that is relevant to determine your taxation. So transparency came up as the third most important output of this policy change. And you've seen the world changing around you on transfer pricing, right? The CBCR, the country by country reporting, the master file. It contains data about the activities that that particular organization carries out in all the countries around the world. Earlier, the transfer pricing report that you had to file with the Indian tax authorities only spoke of what you do in India as a country. Now it's no longer that. You have to now provide details about everything that happens around. So you can't say in India we have 500 people and show a profits of 50 million, whereas in Ireland you have 50 people and you show a profits of 5 billion. Now that is noticed by the tax authorities, and therefore is naturally going to ask the question that, okay, if 500 people sitting here are contributing only 50 million to your profits, how do the 50 people sitting there contribute 5 billion? How are they so different? And then you have to justify. Now, there may be reasons to justify. I'm not saying no. There might be some high-end scientists, technology, research people sitting there, so that's fine. But you need to have that there to justify your 5 billion of profits versus the 50 million of profits with 500 people in India. So the transparency was, an important aspect of this, that over a period of time, each one had their individual laws. Nobody was talking to each other as a tax jurisdiction. And now they are talking together on a common platform. They will share all this data through exchange of information and between the countries and so on and so forth. So those are the things that will happen going forward as we get into. So that's the important part of we understanding that what are the challenges that our clients will face as they go through the next journeys of their next few years. What is the likely outcome? And we've already had the outcome in a number of ways. So you have an international instrument. You spoke about the multilateral instrument in the morning. How it's like a treaty between all the countries that are signatories to that. So you have tax treaties which are between two partners or three partners at the max or within a region. This is a global international tax treaty like the WTO or the GATT and so on and so forth on the indirect tax side, right? So these are the developments that have come out of this, and that's what the future of international taxation will lie in on these outcomes. So what are the areas they touched upon? And I think, again, you might probably know a few of these, but that concept of coherence, substance, and transparency, around these three main pillars of their, search, they came across with about 15 action plans. And each one sort of got divided within these three. So let's take on coherence. The issue of coherence was that people in different countries used to treat the same thing differently. So simple example is, if you take a partnership in India, a partnership in India is treated as a separate taxable entity, and the partners are treated as a separate taxable entity. So each one files their own tax return. Of course, income from the partnership for the partner is tax exempt, but still they are treated as two separate tax entities. But if you go back to the some of the other countries in the West, you will have a situation where the partnership is treated as a tax transparent entity. Means that partnership entity is ignored for tax purposes, which means that if you have a partnership in the US, the partnership is not taxed at all. It is the partners who are taxed on that income. Now, if that partnership earns income from India, yeah, and India says no, the partnership is a taxable entity, whereas US says sorry. So let's say if you're making a payment to that partnership and you withhold tax on that payment under the tax treaty because it's royalties or fees for technical services or whatever it is, right? You withhold tax. The partnership suffers tax of $10 on your 100 remittance, yeah. But in the US there is no requirement for the partnership to pay tax, so it loses the tax credit of the $10 that it was supposed to get, because the tax is now payable on that $100 by the partners in the US. So the partners are separate taxable entities there. In India, you'll say no, I have deducted tax on the partnership and not on the partners. And US will say sorry, I'll not give you credit because the tax is not deducted on the partners but on the partnership. Right? So these are things of coherence or same thing being looked upon separately by two different countries, because each of this is a matter of their respective domestic laws. You don't need to have a common standard, and therefore the idea was to say, okay, these are the situations. Now, where in situations where a credit is lost leading to double taxation, equally there are situations where some of these options can be taken to say that I'll lead to zero taxation. The other side of this example, right, where you lead to zero taxation because you don't tax the partnership in India or in the US, and in India you say the partnership is taxable, but if the income is outside India, I'm not taxing you. The partner should not be taxed as well. So if an Indian partner with a US partnership, you will probably have no taxation at all in either of the locations possibly, right? So these are examples of cases where you could have had different approaches on the same situation because each of the countries had a domestic law which was not coherent with each other, and it need not be, but that was the outcome of what it was. CFC rules, I mean, again, controlled foreign corporation. When an Indian entity goes outbound and has subsidiaries or etc., they are controlled foreign corporation. So again, around those. Now, India does not have a CFC and may not probably bring it for the next couple of years at least. But again, this is very important for countries like the US and UK, which have detailed CFC rules and so on and so forth. Interest deductions, we spoke about how interest deductions can be taken, and now India has brought in the anti-avoidance regulation, right, 94B, which says that if your interest deduction exceeds 30% of your EBITDA, you are not allowed any further interest deduction, and so on and so forth. Some of those are outcomes of what has passed on here, what has happened here as debates and deliberations. Those are outcomes coming from those actions that were taken here, or the discussions that took place, because India was an active member as well. Harmful tax practices, we said locations like Bahamas, BVI, which give you zero tax without any substance requirements in those countries. So you can just keep parking your profits and you get zero tax. So those are harmful tax regimes or harmful tax practices that they've put in place in those locations. And again, something which is, which was a focus of this study. Substance, preventing tax treaty abuse. I think this is one of the biggest thing what we all commonly know as treaty shopping, right? Probably you would have learned how the LOB clause has been brought in or the principal purpose test has been brought in. So those are the things to make sure that if you are claiming a treaty benefit, you are one who is eligible to claim the treaty benefit because you have sufficient nexus in the country whose treaty you are claiming as a resident, right? You cannot claim a treaty just because you set up an entity there, but you claim a treaty because you have sufficient business presence or nexus in that country to be able to claim and say that I am a resident of that country because I do certain business activities or I have a significant level of presence there, and therefore I should be eligible to be governed by the treaty. And when you are a resident, when you get a treaty benefit, why do you get it? Because you are contributing to the tax coffers of that country, right? And if you are contributing, that's why you are treated as a resident of that country, because you're carrying out business activity, you're paying tax there. But if you don't pay any tax despite earning profits there, then really what is the purpose of you being a resident of that country from a tax perspective? Okay. And yes, over the years, the countries have encouraged that type of borrowed residency, or trying to claim artificial residency by setting up entities, because they wanted to increase the economic activity in their countries. So why would a Mauritius want people to come and set up holding companies? Because it enables Mauritius to have a very flourishing financial services sector, because more the companies come there, they'll open bank accounts, they'll want insurance, they'll want other services, and the banking industry in Mauritius flourishes. So those are objectives which were important for the country at that point in time to encourage these type of practices, because it gave them the benefit on the economic side by having more banking transactions and so on and so forth. But over a period of time, those have been misused, abused to be leading to this situation. And as they say, wherever there is ati, there is a fall. So that's when this level went to a situation where they could not any longer survive. This is where the action has happened on that. PE status, artificially avoiding PE status. I'm sure in these PE definitions, etc., you would have looked at some of these things on dependent agent PE, how you avoid a dependent agent PE, and so on and so forth as an agent, and that. Transfer pricing. Transfer pricing is all about business and economic substance. So everything that you do in transfer pricing is not based on what letter of law or arrangement you enter into with the other party. It is about where that business activity has happened and where it has generated the profits. So there has to be a linkage between the activities and the profits. So everything that transfer pricing tries to do is to make sure that the pricing is worked out in a manner that the profits are in the location where the activities have been performed, or the purpose of that entity has been served. So that's what is all about transfer pricing, and was a big focus area, and we'll probably speak about transfer pricing in a little more detail as we go there. The third limb of it was around transparency. So it is less to do with what you and I will work on for clients, but it is more about what is it that the tax government and the tax administration will put in place to collect data, to be able to analyze data, and so on and so forth. So they will have statistical tools available, and has everybody heard about CAS? CASS? Computer aided specific selection of these or assessment cases, right? What is that? It is a mechanism, it is a statistic tool that the government is trying to apply based on a risk assessment, and saying that which are the taxpayers that I should be selecting to go and audit for. I don't want to go and do everybody, because I don't have enough force to do and audit everyone. I will select the ones where I see there's a sensitivity, where there's a risk of some income having escaped taxation, or so on and so forth. So that's the whole approach that governments all around the world, with technology, digital, everything being online filing, they have the ability to say, okay, that if there are so many cash withdrawals of this entity under this PAN number, something is fishy, right? If they are doing so many cash withdrawals from the bank, yeah, and so on and so forth. So that's how the new data analysis and methodologies will be applied by tax administrations to be able to catch the right taxpayer for audit and so on and so forth. Disclosure rules. How many times in the last 10 years have you seen the tax return form being changed, right? probably every year it changes, right? Disclose your bank account outside India. Are you controlling and managing that bank account? Are you a director in a particular company? Are you a shareholder in a particular company? Haven't we seen all of these disclosure norms coming through, right? These are, I mean, sometimes we say, why did this, they have to ask this question? But there is a deep policy thought to say, okay, we need to gather this data around and try and find out that if you are controlling a bank account outside India, are you the person who is running that company or that entity outside India? Are you a signatory to that bank account? Are you the one who is really the owner of the funds that are lying in that bank account, but you've just parked it in a company outside India? And that's why the POEM rules came into place, right? The place of effective management if you have a foreign company, etc. So you see the linkage of, this is an important part that I think we cannot talk about everything that has been done here, because as I said, each of these things is probably 2-3 hours of discussion, debate on every point. But the linkage of all of this to the way the rules will change, the way the governments will or the tax administration will react and act in the future is something which we need to probably try and understand and decipher, that this is the thinking that is going on at the policy level, and this is what therefore will lead to different types of changes in the law or disclosure norms or the tax returns or the audit process and so on and so forth. Yeah, with this GST coming in. Now, GST has the ability to be able to capture all the transactions that are happening in the country, right? Because there's a technology which captures everything. Earlier, people used to file manual returns on VAT and so on and so forth, right? But now, if GST has the ability to capture all the transactions that are supposedly having done, and of course, we all know there are transactions which will not get captured on GST, but at least the transactions which are getting captured on GST against a particular PAN number. So if you are doing a transaction which you disclose in GST, but are not disclosing in the corporate tax accounts, it's very easy for somebody to just go and question you on that. It's like the 26AS that we see for TDS and income, right? And if you have a particular tax deduction and an income in your 26AS and you don't disclose it in your tax return, immediately you will be questioned on that, right? So that's how this methodology, data analysis that is going to happen is the future of taxation. And at some point in time, in New Zealand, for example, I don't know if many of you know this example, that New Zealand has a company, and which is a company which is hailed as the zero to hero, because the name of the company is Zero. That company came up with a software which they sold to the government, and that software was, it linked the government systems to the ERPs of every companies or taxpayers in that country. And from the ERPs, it straight away captured the transactions and computed the income. And you don't have to file tax return or have a chartered accountant to do it for you. The government will send you a bill. This is what your income is. You have to pay so much tax. Please pay it by so and so date. That's it. Audit completed. Nothing to be done. Okay. So that's the future. And God knows when it will happen in India. One of these bright, sharp minds will have to do it in India. Yeah, but that's how they do it. It's as simple as that, right? And they got that software validated by the government and so on. So technology will, in a big way, come and capture this thing. And the government will use everything to make sure that there is no leakages and things around there. TP documentation, I think we've spoken about CBCR, all of that. So I think those are important. Dispute resolution, big issue, because you had disputes in countries like India which go on for years and years, and it's a pain. So while we are trying to attack double non-taxation or anything avoidance of tax, equally there has to be a mechanism to make sure that disputes between the governments get resolved faster. And imagine this, what will happen in a situation like this. You've had a situation where you're interpreting a global instrument, right? The multilateral instrument, for example. Now, you are a taxpayer. You've had a transaction with a taxpayer in, say, a country, USA. Okay, so you both have entered into a transaction, Indian entity transacting with a US counterparty. That's the taxpayers in both the countries. But the multilateral instrument will say who will pay tax what where, right? Because that's how it will allocate the taxing rights. If there is a doubt on the multilateral instrument, the Indian government will first ask the Indian taxpayer, no, I think the MLI requires you to pay tax in India, right? The US will say, no, I think the MLI requires you to pay tax in the US. You're not supposed to pay tax in India because you don't have any activity in the India, for example. And therefore, imagine who two will be fighting with each other. The government, right? I mean, you will be observer. जिसको लेना है ले लो मेरे से, right? But that's how you see WTO or GAT double T. What happens in WTO? Are the taxpayers or the transacting parties fighting? No, it is US saying India has imposed anti-dumping duty on steel, or China saying India has imposed anti-dumping duty on tire. So China and India keep fighting at the WTO, right? The taxpayers are not fighting with each other. So this is how the future can change in this era, in this regime. You have a different era, different regime with these type of international trade documents or international taxation documents being signed. You will see that the profile of how and what we do will change significantly as we go forward into the future, right? So again, three pillars. Digital economy is not out of these three pillars, but it is basically a response to the business change, the model change that we spoke about. Technology, right? How do you tax digital transactions, right? Anybody can recollect an example of how India reacted to taxing digital transactions? Equalization levy, right? I mean, apt example of how unilateral action taken by India is impacting the world trade, right? Yeah, software. India wants to tax every software that comes into India, right? Now you can't tax that. That's not the way. If you tax every software at every end of it, that's not the way you go about doing it, right? You want to tax a digital transaction, we are not saying no, but every software is not royalty, right? Unless there is an intellectual property being transferred from one to the other, you can't tax it as royalty, right? If you want to tax every download on the app that you do, or every download of content that you do on the internet or the webs and all, that's not the way to go forward, right? So these are things where they want to have an international standard of saying how we go about taxing some of these things. We want to tax, the government should get its fair share of taxation, but how do you go about, what is the right level of taxation, and so on and so forth is the subject matter of all of these debates and discussions, right? Now everything is not going in the right path, so let's be clear that whatever they come out with may not be the only right solution that exists, but that is being done with a lot of international consensus, that is being done with a lot of participation from multiple countries. So I just wanted to put down the key participants who are already there. So if you see, almost 90% of the world gets represented in these participants who are participating in this activity of making the new policy for the future, how the tax policy will work. So with G20, it started the 20 countries. They mandated OECD. OECD has about 70, 80 members and then observers in the OECD. Yeah, and then you have the IMF, World Bank, the UN participating in this. All of the large tax organizations, including India's key organizations, have participated. The regional blocks like the SAARC, South African bloc, and so on and so forth have participated. So you've covered almost 80-90% of the world who have participated in bringing out the policy for the future, right? And that is what you've had so much deliberations and tried to arrive at something which is hopefully consensus. You can't satisfy everybody with such a large participation, but at least try to arrive something which is close to consensus, if not full consensus on this. And now you have almost 120 odd countries which have signed up to the being the having an inclusive framework for implementing it. So basically they will take up each of these policy decisions that have happened and start implementing them over a period of time. And as I said, India has already started. It's way on. Probably India started much before they brought BEPS, right? Some of these things that we've done, like software taxation, was even before BEPS came in. The amendment to Section 916 was much before BEPS started thinking of digital taxation and so on and so forth. So India is very actively participating, and we are seeing the changes of it happening. The interest, Section 94B being brought into the picture. You will have, India has already given its reservations, etc., to the MLI and so on and so forth. So clearly it's at the forefront and wants to take this forward in a big way. And that's where most of the big countries, if you see US, UK, Switzerland, Netherlands, Germany, France, Japan, everybody is a part of this. China, including some of the largest Indian treaty partners like Singapore and Mauritius. I mean, 95% of our FDI comes through these two countries. Yeah? So all of them are part of it, and therefore it will impact each one of us. Next time when this MLI comes into force, Yeah, you are evaluating whether a capital gains earned by a Singapore company from sale of shares in India is exempt or not. You'll have a tough time. It's not no longer easy to say it's exempt. You'll have a tough time to find that out. What does it mean? So those are the changes that will happen in the next 1 year, 1.5 year. I mean, it's probably a little far off in that sense, but it is something which is already on the horizon. Yeah. So what happens in this is BEPS is trying to say we need to increase the maximum revenue tax collection that a country needs to do, right? So maximize revenue in some way or the other. But why were these regimes in place in the first place? Because these countries put these regimes to attract economic investment. Why does India give zero tax to an SEZ unit? What is the benefit that India sees in giving zero tax to a foreign company setting up a unit in an SEZ? Because it sees that it will set up a shop here, it will have to set up a factory, it will have to employ local people to run the factory. It can't get people from abroad to run the factory and so on. So it will increase jobs, it will create employment opportunities, it will increase the economy capex cycle in India and so on and so forth. So India has an inherent interest in incentivizing people to come and set up shop in India by having an attractive foreign tax policy, right? Equally, all the countries of the world want to do that, right? They want to get more capital into their country, more people coming into their country. You migrate. I mean, in the EU, you've seen all these foreign soccer stars and all keep migrating from one country to the other because they get a huge tax benefit of being a sports person and getting a lower tax rate in an Italy or a Spain and so on and so forth, right? So those are regions which will not be. So there's always a tax competition between countries. Here is a system where they got together and started behaving like one. But remember that this will also not be forever. Like how tax competition was not forever, this will also not be forever. And therefore, there will always be these cycles of thinking that will keep changing. And to my mind, that's already started. The tax competition, as the race down to the bottom, has already started. And who's at the forefront of doing that? Right? Yeah. What is the US doing? Saying, come in, set up your shop in US. You will not pay 35% tax. You will pay 23% tax, 21% tax. Right? So, did anybody read the Economic Times yesterday that Indian pharma companies are saying we'll go and set up manufacturing in the US? We'll not want to be setting up in India. Why should we pay 33% tax? Now, so what will the Indian have to do? Indian government have to do? What is Mr. Jaitley thinking? Was इन लोग को इधर रखना है तो भाई कुछ करना पड़ेगा. Yeah. So here is one event where they are trying to say we will want to enhance our revenue collections. Equally at the same time, there is a competing force at play, which is saying that we will have to be competitive. We'll have to be giving an environment which people come in and do investment and do business in this country, right? And India is not only only person smart enough to think about it. Everybody is thinking about it, right? So you'll see the tax competition will see a race to the bottom. 18%, 17% is like the bidding, right? Everybody will say this, right? So I don't know what is this. What is this? Pick snooze. I'm very bad at technology. Yeah. So so with that, these are things that may survive. Some things may survive. Some things may not survive because the way the economic response will be much different, and therefore people will have to adapt to and change. Yeah. So it's a very dynamic situation that these things are, and it's not dynamic that it changes every 2 days like the stock market. It changes every probably decade, that the policy responses of the governments and the world over changes based on how the economy is doing. So you had 2008 when they gave this response, when the world economy was in a deep recession, right? You have 2018 today, where you see the world growth is at the highest, or will reach the highest peak, and therefore the objectives will change suddenly from the government side. It's not going to be static. It is always going to be evolving. The policy will keep changing as we go along, and that's what is important for us to see, that okay, 5 years down the line, what is it that we are seeing? What is that crystal ball gazing that we should be doing to be able to, as a client, give the right advice to the client as to what is going to happen in the future, right? So this is an important part of what we as professionals need to be getting into, and we're not sort of assuming that we'll start guessing things and putting a bet on something. That's not the way it is. But at least from the decisions, the policy making that is happening, we can imagine the thought process of the governments, the world organizations, and probably on that basis make a more informed decision as to what is going to be coming in the future. What would happen to the countries who are not participating? We have about 120 countries who are participating. There are other 80 countries who are not participating. So probably they may face sanctions. So if your client has entities set up in those jurisdictions, they may be having sanctions. Did India put sanctions on any country? Cyprus, right? Why did India put it? Because they are not cooperating as a tax jurisdiction with India in exchanging information and doing all of that. They said, okay, anything payment to Cyprus, 30% withholding tax, flat, right? So this is what can happen with countries where you have entities or do transactions with, but they are not participating in this global policy change, right? So again, if you have clients with country entities in those jurisdictions, or you do business with those jurisdictions, you have to be careful because your cost of doing business can go up in doing this, right? So again, something which you need to start thinking and say that. So whether they'll put as a harmful tax regime and then impose all conditions or sanctions, as the US very proudly likes to say, and so on and so forth, we'll see what happens for those countries. It's not yet done. So if you see the ones that are participating are all here. Yeah, I mean it does cover a major, but if you take Seychelles Islands, if you take, and there are multiple entities which do operate out of those jurisdictions as well. So there will be those entities which are not putting up there, and Netherlands, Antilles, those are smaller jurisdictions which are there, but they will be entities which are not participating there, right? So what are the 3 or 4 things that have come out already? There is a change in the way they've put up with a domestic law design, that you need to have your domestic law in a particular way such that the domestic law in each country is the same, because not everything that we do in taxation is only about tax treaties or cross-border taxation. It's also about your own domestic law as to how they are structured. How does Section 90 read in your law, in your Income Tax Act, and so on and so forth. So if there is a domestic law design, they are coming up with that as a standard benchmark, that this is what your law in your domestic act can be. Changes to the Model Tax Convention, we've already seen the multilateral instrumentation. Changes to the commentaries, so the way you interpret a particular existing provision is also being updated by as a result of this thing, and therefore you get a updation which is more in line with the current economic trends and all of that. Changes to the transfer pricing guidelines, for example, again those are things which are important and changing. Data collection, documentation and disclosure guidelines. So these are again in your tax returns, what all disclosures you need to do. For instance, in the UK, you are required to file with the tax return any tax positions or tax planning that you have done above a particular threshold. So even if you think that this is absolutely fine, you did a merger which gave you a tax benefit of 50 million, right? You need to disclose that specifically in a particular case. Now, the tax authorities has a disclosure of all that you've done, which possibly gave you a tax benefit of exceeding a particular threshold, right? So that's the first port of call for him, right? That is there anything fishy in these things that they've done, right? So that's the next steps in which this will go. So whenever you're doing something, doing all of this, none of this. So Naresh bhai told me that we've all said nothing is doable, and that's not the answer, right? Whatever we are doing, whatever we do with our clients, we need to be not just doing it. While this session, as I said, is scratching the surface, when we do advise our clients, you cannot any longer scratch the surface and advise. That's the important part, right? You have to get into details of it and say, okay, is this in line with your commercial business rationale? Is this in line why you would do this? Because it gives you a business advantage as against giving you only a tax advantage. And it's not that you will not find that answer. It is that you need to search a deep dive and find that answer, because there is always an answer, right? But that's the change that will have to come about in the way we are advising in the future to our clients and so on and so forth. Yeah. So nothing of this says you cannot do anything, and tax planning is far away from being dead. Our employment is all there for several years now. Don't worry about it. It's all got more important, because they will not be able to do it without you guys, right? So, but you need to find that right answer. You need to not just, as I said, scratch the surface. You need to get into a deep dive, understand the business, understand the rationale, understand what drives the business, what are the parameters that goes and leads to it. I mean, tax has just become much more exciting. It's not it's not getting dull, you know. And all these new people who come to our office and they say tax is boring and dull. I said let's start doing this. We'll understand how it is boring and dull. Huh? Okay. So we've probably, I think you today dealt with PPT and limitation benefits, right? So probably I'll skip that part on treaty abuse, etc., because I think you've already done with these things. Entitlement of benefits, I think is fine. Just so that you know that the practicality is, I don't know if you've probably dealt with this, but about 68 countries have only adopted the principal purpose test, right? Whereas the limitation on benefits is being adopted by only 12 countries. So only India is one of that 12 countries. So India is having an limitation of benefits clause, is one out of the 12, or one out of the 12 out of the total 120 odd countries that have signed the MLI. So India is going a little far off in terms of getting this as an acceptability in this thing. Yeah. So I think I'll probably skip some of these things. Yeah, and I know if you want to, you've 3 months has not been enough for you, and if you want to solve further case studies, I've kept them in the presentation for some homework, but I'm not dealing with on the Saturday. Transfer pricing. I think this is one bit, and I again not getting to the details of it, but just to give a flavor of it, the three critical areas that they touched in transfer pricing. One is intangibles or intellectual property, which is a key business driver, is a key profit generator for any MNC or any business in that sense. So that's one area which has the maximum profits that can be attributed if you look at the different advantages in a business. Risk and capital. I mean, capital is no longer only about who puts in the money. It's about really who is taking the risk, right? So if you have a company in the US which sets up a subsidiary in, let's say, Bahamas, and puts in $1 billion in that company in Bahamas, right? And Bahamas now makes investments into an Indian R&D center and starts a captive R&D unit in India and starts developing intangibles in India, right? So who's putting the money in India to develop the intangibles, right? Who's doing that in the scheme of things? So US, you had Bahamas. Bahamas ties up with a captive R&D unit in India and says, here is the money, go and take whatever it takes to research this and build a new technology or a new product, right? Who's putting the money on the face of it? Bahamas, because if the R&D happens on legally, who's the owner of that intangible or IP? It's Bahamas. Yeah. But did Bahamas had the capability to put that capital in the first place? This is the question that you'll ask now, right? So until now you'll stop here. Oh, Bahamas had the arrangement with India entity. It was developing the product in India. It had the money on its own bank account. It put that money in that bank and invested that money. Because if the product would have gone wrong, Bahamas would have lost $1 billion on face of it, right? Because they put in money and the product is not materializing, then they would have lost the $1 billion on research, etc. That's what we looked up till now, the form or the legal transaction. You will no longer do that now. You will move forward and said, but did Bahamas had the capability of taking that risk? Did it have a balance sheet to suffer a loss of $1 billion? And the answer to that is a clear no, right? It is only because it had a parent supporting it from out of the US that it was able to invest the $1 billion in the product development, right? And therefore, when you go forward, you will say, is the risk and the capital that is coming from the entity which is putting in the capital to do that investment and the risk with the same person? And if the answer to that is no, then you probably need to not look at that legal arrangement or the arrangement that looks on the form of it, but deep dive into finding out what the substance of that is. Where is the IP really sitting thereafter? Because if the IP gets developed in Bahamas, and Bahamas will start charging royalties to everybody in the world for producing that particular product, and will earn a huge money probably $10 billion. In Bahamas, you would pay no tax, on all the profits or royalties that you get in the future. But that's not the way, because if this IP would have been in the US says, sorry, you would have paid a huge tax in the US, because you have this $10 billion fully taxable in the US. Because I really supported this IP generation. If Bahamas would have failed, my $1 billion was at stake. It was not Bahamas's $1 billion which was at stake, right? So those are the questions on risk and capital. Are the risk with going with the capital or the entity which you are showing as putting in the capital? And that's the question that you will probably get into and ask. And other high risk transactions. I mean, there are many other things like R&D, for example, is one example. Marketing intangibles that created. So you have a marketing setup, a call center, which is going and selling products all around the world, sitting out of a particular location. So India, as you know, is the call center of the world. So you have people in India selling credit cards to people in the US and UK and everywhere, right? Is the profit to be done by those people, or is the profit to be done by somebody who is funding those people? So again, these are high risk transactions that are differently to be looked upon. Profit sharing arrangements, revenue share arrangements. Again, something which is a typical type of a high risk transaction that one will have to look at. So what is it that they have come up as a basis to determine for intangibles or these high value transactions, as to how do you determine the profit allocation? So in the case of intangibles, they've coined this term called DEMPE. Has anybody heard about DEMPE? Yeah? Yeah. So I think half of you have not. But let me just put this down. It's very simple. It is not a rocket science. D stands for development. E stands for enhancements. So what are the stages in an IP? Just imagine these are the stages in your IP product development that you do. You develop a new product or a new IP, right? New brand, new technology, whatever. You're developing it. You may have an existing IP. You will enhance it. You'll make it better. You'll create new versions of it, and so on and so forth. That's an enhancement. Then you have maintenance, M, because everything that you have to make sure, these apps, you have to fix the bugs, and so on and so forth, right? So this is more like a maintenance activity. The P stands for protection, because if you have an IP, you have to protect it, that it is not infringed by somebody else. You need to incur legal costs to do all of that, and so on and so forth, right? And then the last E of the DEMPE is exploitation. You use the IP, right? You actually use to make profits in some jurisdiction or the other. So this is what the DEMPE requires, that in respect of any intangibles, these are the 5 areas that you focus on and decide which is the entity which is in substance carrying out these functions of DEMPE, and then allocate the profits from the IP to those functions in that particular manner. Now it may be so that development and enhancement is done by A, protection and maintenance is done by B, and exploitation is done by C. Then you need to break the profits in these 3 ratios and allocate the profits based on that, right? So this is all about, in nutshell, what intangibles and transfer pricing developments are, in this way. Similarly, with risk and capital, they will go into similar things that, as we discussed in the example, is the entity which is putting the capital really the risk taker, or is it somebody else, or is it backed up by somebody else, and therefore he's not the ability to take the risk, and therefore the profits should not be going to that. If he's putting a capital, what is the return that you get on capital, right? If you put your capital in a bank, you are a passive investor, you don't do anything. You put your capital in a bank, you get 5% in globally, maybe in India you'll get 8-9%. That's it. So if that is what he's doing, he should only be given a financial return, not the return of the business risk that was taken on the IP, and so on and so forth. So when you get your profits of 100 on an investment of 50, they'll say that the entire 100 cannot go to you because you created the intangible, or you are the legal owner of the intangible. You put it 50 as a financial investor. You will get only 10% of 50, which is $5, right? The $95 belongs to the person who took the risk on the intangible. And if that person is sitting in the US or UK or India, wherever it is, they should be taxed and not you. That's how the transfer pricing will allocate profits based on the principles of substance, based on where the value generation has happened, and a true determination of the character of each of the entity. So is he merely a financial investor? Is he the risk taker? Is he only a pass-through entity? Then he probably gets nothing out of that, right? So that's how so it's more getting closer to the economic reality of how that business has generated profits. It's as simple as that. Once you get closer to that, you have the ability to allocate it in the manner, in the right way. Yeah. Okay. I think again, some of these things you probably would have heard about on the CBCR, so I'll not get into too much detail. I think we also have to create cover GAR. So a master file is, again, this is part and parcel of we saying disclosures, transparency. You need to ensure that the multinational corporation is disclosing everything that is happening around the world to the tax authorities of each of the jurisdictions where it is operating. So they'll create a master file which will give the details about all their global operations in every country, where the intangibles are, where the maximum number of people are, which activity is a manufacturer, which is a seller, which is a marketer, which is a IP owner, where is the development of the IP happening. All of that details will come across in one document, which will be shared with everybody around the world. So the FAR analysis, etc., that you do in the transfer pricing study reports will be much more comprehensive, because what you're doing in the transfer pricing study report today under Rule 10 is only about what is happening in India. It's only about the local operations for the transactions that you've entered into with foreign related parties. But now on, this master file will require you to provide details about what are the functions, assets, and risk across the world, across the entities that that multinational corporation operates anywhere in the world. Right? So this is what the change on transparency or disclosure norms are, so far as transfer pricing is concerned. The local file is very similar to our transfer pricing study reports that we do under Rule 10. It contains information about the transactions with the related parties with the domestic country, and so on and so forth. So those are similar to our TP study report. And then CBCR is nothing but a summary data of all of this, right? To say, okay, it has some 20 odd columns which are put up there country wise, and each of these columns looks into and says, okay, what are the number of employees you have in a particular jurisdiction? What is your net profit of all the entities in that jurisdiction? What is the average salary cost in those jurisdictions? So these are, again, what will a person do with this data? That's the next question that you need to ask, because if they're collating this data, that means there is some relevance of using that data, right? So what is the use of that data? The use of the data is to see, as I said in my starting example, that if you have 50 people in a particular country and you're showing a profit of 5 billion in that country, versus you have 500 people in India who are doing in a captive outsourcing unit in India, and you're showing a profit of 50 million. Right? You'll say 500 people in India contributing only 50 million, whereas 50 people sitting in Ireland contributing 50 billion. How does that work? And that is where the tax authorities will go behind and say, okay, I need to see what is happening in Ireland. Or are you really doing the work in India and saying the legal owner of all that work is Ireland and therefore putting the profits in Ireland? Or is it that you really have significant people in the Ireland who are your top of the notch units, who do the development, research, etc. of the intangibles and so on and so forth, and therefore you are right in what you're doing, right? So there's nothing which says that just because this is the statistics, you are wrong in what you're doing. Because if India is doing very low value jobs of answering calls, you can have 500, you can have 5,000 people, you'll make the same money in India. You're not supposed to make higher money, right? But if you are doing a much higher level work in India, and everything that Ireland is doing is funding India and saying you do it for me because I'm giving you the money, then they will question it and they'll say, okay, it's not the money that is important, because if they're putting the money, what should we get? We discussed that, right? If they're putting the money, they should get an interest on whatever money they've put in. But everything that balance profits that is arising because of that activity should be to India. So the 5 billion you start putting back into India, because they should be getting the right share of that. That's about base erosion and profit shifting. They would not allow you to shift profits from out of India if the activities which are leading to that profits are done in India. They don't want you to erode the base or the tax base of India. That is all about BEPS in a simple example, right? Base erosion and profit shifting. They don't want you to do that. And this is what the future of transfer pricing will lie from the CBCRs and the filings that you do and so on and so forth of the world.
Regarding this risk and capital, suppose on part in the IPO makes a new adjustment based on these guidelines. So suppose US companies are parent. So US will say, no, we don't agree to all these things. So this is not MLI which all countries have agreed. So what will happen? Whether the claim will be denied and Indian company will suffer that, what will happen?
Right. So there are two, three alternatives there. One is you have India saying you need to pay tax on the 5 billion, suppose. US will say no, you also need to pay tax on 5 billion because this IP was in the US. You'll keep fighting with these respective on a one-on-one basis. Then there is this ability to convert this into an APA or a bilateral APA or a mutual agreement procedure and say, okay, if I can't resolve with each one of you individually, the two of you resolve because I am ready to pay tax on the 5 billion. I just need to decide whether it is to be paid in India or in the US. It's like GST also, right? You have, you will say one of the state is Maharashtra, the other is Gujarat. Now you decide where I need to pay. I am okay to pay this tax, but you decide where I am doing activity and paying the tax. So same thing, they'll probably have to escalate as a dispute resolution mechanism into a bilateral dispute resolution mechanism and say US and India, the competent authorities need to get together and resolve this impasse. So this is what happened with IT companies. The JP Morgan was one of the classic IP, the map that got resolved on transfer pricing issues because India was saying you need to pay cost plus 25% in India. The parent entity sitting out of the US said we can't allow you more than cost plus 10% because the markup in the US is only 10%. We can't allow you to pay more. So if you have paid 100 plus 25, 125, in your tax computation will disallow 15 because according to us you can only pay 110. That's what the US said. India said nothing doing. You have a huge cost saving in India. You have to pay cost plus 25. So the taxpayer took everybody to mutual agreement procedure. The two competent authorities, the governments came together and said, okay, cost plus 16 is the right answer. Now, it may be a settlement, it may be, but it's the way to resolve an impasse on this. Now, not saying everything will get resolved in this manner, but this is a mechanism available to resolve it. And therefore, one of the other parameters on dispute resolution that we spoke under BEPS is that because the map, as you might have probably would have already gone through map procedure, it is not necessary that the competent have to agree to come to an agreement, right? They can agree to disagree on a map. So therefore, what this BEPS is saying is that if you disagree after say 2 years of discussions and negotiations, then you need to compulsorily take it to arbitration, which means that there will be a resolution at the end of the day because you can't get the taxpayer to suffer because of that. Now, India has put a reservation that will not take every cases to arbitration. So there are issues on that. But the mechanism that they're trying to put in place is to ensure that a map reaches a logical conclusion at some point in time. It's just not that the governments keep sitting and not reach a conclusion because they have to reach a conclusion. Otherwise, there's double taxation in the example that you are trying to give. It does. It is a long-term process. Absolutely. Absolutely. It is a long-term process if you are not able to resolve the impasse. So, because on an average, a map will take you at least 3 to 5 years. It's not something which will get resolved in like 1 year. Because by that, the whole diplomatic channel that it works through, it takes its own time to get processed. The competent authorities meet. In the US, you probably meet twice or thrice a year. But with China or Germany, you probably meet only once a year. So your case has to be on that agenda, on that meeting to be put up and so on and so forth. So that's not an easy process of resolving under map because the two governments, the elephants talking to each other, basically. Just move at their own speed. APA is also, but APA is a unilateral process. You need to convert into a bilateral APA. The moment you convert into a bilateral APA, again you have the two governments coming and talking with each other. It's the same process. The name is different, map to APA, but the process remains more or less the same because you have the two governments again talking and if you do a bilateral APA. Because the answer to his question is in a bilateral, not a unilateral APA. Because even if with India you agree at cost plus 20, you're still having a gap of 10% because the US is saying cost plus 10. There's no point doing a unilateral APA. You want to get both of them to be doing a bilateral APA. Yeah, I think probably we spoke about. I think many of this we have spoken, so probably we'll move forward. Transparency, information gathering, the UK example that I gave, dispute resolution on map and arbitration, we just spoke about that. Multilateral instrument we need to do. So this mandatory disclosure scheme is again a standard design that they have created under BEPS as to who needs to do what, right? So all of this is written. What does the taxpayer need to do? What does the government need to do? And so on and so forth. So this is a standard design they've come out under Action Plan 12 under BEPS, and you will see over a period of time this being put into the respective tax laws, domestic laws of each of the countries. So they've created a standard threshold benchmark, and they'll probably implement this in the domestic laws, tax returns, filing, etc. that you do in the country. They'll bring this in over a period of time as we go forward. So again, dispute resolution, again, the idea is to, as I said, India is not a party to this compulsory arbitration if the map is not resolved. India has not said yes to that part, so it can still keep it as an impasse if the competent authorities don't agree on a particular solution. Yeah, that's on map. Multilateral instrument, I think probably we'll skip. Uh, I'm sure you would have probably dealt with all of this, right? That which agreements are covered, what is the date of entry into force, because it's very, everything that today when you're applying a treaty, you are just reading a tax treaty, one document, which article, at the most you'll read a protocol to the treaty and say, is there any change to that article, and that's it, right? It's no longer that now, or it will no longer be that now in the next 1 year, 1.5 years. You have to take the treaty, then you will see the multilateral instrument, then you will see what has India taken its positions under the multilateral instrument. Has it made any reservations on a particular point or not made a reservation? Is that particular treaty a subject matter of reservation or not? Have they put in any existing provisions which are not subject to the exception or the reservation? So it is like a matrix that you'll have to now create, and I'm sure somebody will be able to crack this after 5-10 years of doing it, that you'll have a standard matrix available, by which time everything will change. Yeah. So, but every time that you will now apply a tax treaty, yeah, I mean, now meaning now is relevant when you are planning something for the future, right? Because if you know that 1 year down the line this is going to be the change, then you need to have a completely different answer for that. You can't plan something today which does not take into account the future MLI coming into place, because it will come into force in maybe 6 months, maybe 1 year, maybe from financial year 1920 is the year when you probably need to start thinking that this will be applicable, and so on and so forth, right? So if you're putting something in place today, you need to start thinking what will be the situation in 1920, 2021, 22 and 22, right? And that's when you start needing to think about all of this, and these are all evolving every day, and you can change everything as a government. You can change anything that you want. What they did is to arrive at global consensus. They said, we'll keep this whole thing together, and then we're giving you options what you want to do. So you can say, I want to take this, cherry pick. I want to take this, I don't want to take this. Like India says, I'll not take every map to arbitration. That's India's choice of reservation, that I don't want to do that. But India says, I will bring in principal purpose test and limitation of benefit rule in every treaty that I want, and more. Right? So it's a cherry picking by India, and I'm sure everybody will do there with their own considerations in mind. But equally, when India makes a reservation, yeah, and some other country also makes a reservation, and when you're looking at the tax treaty between these two countries, you need to be mindful that it is not that just because India has made a reservation, it will apply qua India. If the other party has not opted for that article or that change on principal purpose test or a limitation of benefits, because if you saw the limitation of benefits, only 12 countries have said yes or adopted it, whereas the 122 में से सिर्फ 12 लोग. So the other 110 countries have not adopted. So the treaties that India has with other countries cannot be reading an SLOB in that treaty, right? Because they have not adopted it. So it has to be equally applied for both the sides. India can say, I will apply. Mauritius say, I will not apply. Then between the treaty between India and Mauritius, it will not apply, right? So that's how your matching or the metrics that you will ultimately create when you want to answer your client queries or your live situations. You'll have to look at each of these aspects and come up with that, because it will be specific, as I said, qua every treaty. It will be specific qua every treaty partner. It will be specific qua every article, and it will be specific qua every sub-paragraph of the article. Okay, so anytime anything that you do has to be ticking the box everywhere. Unless you get that envisaged, you're not reaching the right answer. That's the importance of that. Because there are situations to deal with mismatch. If there's a mismatch between India and UK, what has India done? What has UK done? If you are applying the India-UK treaty, so India does something, UK does not do something, then there's a mismatch. Then there's a rule how mismatches are to be resolved, and that rule is not standard everywhere. That rule depends on what is the language of the MLI article. For example, this is when it will come into effect, etc. So I've just given a tentative timeline on what it will be if India were to do the first of the actions by, say, February 18. These are, again, just be clear, these are very tentative. This is not information that they will do by 15 February 2018. But assuming if India were to do by 15 February, it will probably come into effect in 19 and 20, as the first of year of implementation of MLI, if India does by this date. But this is, as I said, is only illustration purposes, just to give the calendar, because this whole timeline is a formula that has been provided. So it depends on what the first date is, and then the formula applies in a particular way. You don't have to, you can't change anything over here. So long as you do something here, this is your first action as India or any other treaty, and then you have a timeline which is a formula-driven timeline. You can't change anything thereafter, right, on the implementation date or the entry into force and so on and so. Yeah. So I think we just give an example. So this is how you will determine all the treaty evaluation, that you will look at the MLI, look at the treaty, what is the MLI position of India, MLI position of UK, and with these 4 documents, we'll now read what is the final answer on applicability or the taxability of a particular type of income and so on and so forth. So as I said, if there's a mismatch, it depends on what is the MLI language. So MLI languages is 4 different types of languages are there. You have an article which will be in place of an existing article. So they've used the word in place of. Then you said an article which modifies an existing provision of the treaty. So this is the word modifies. Then says if the treaty does not have a particular item, in the absence of, then a particular provision will be inserted. So if it has something, it doesn't insert that provision, right? And then you have, even if it has something, then in place of. So if you have something or you don't have something, you replace it by this article, right? So this is the English language used to its optimum to confuse all of us, right? They're different. So when you applying an MLI, reading the article, you have to see which one of this is, because each one, the impact of each one is different for each treaty and the main treaty that you're reading, and particularly relevant if there is a mismatch. Mismatch is when you have opted for a particular article as India and the other treaty country has not opted for that article or for that treaty. In that case, what happens? The mismatch rules are very different for each different language that is put up there. So when you're doing that, you'll have to be putting this sort of a metrics in place, as I said, to evaluate it. I mean, just give an example. You can, if you're very keen and very interested, as I said, homework for Saturday and Sunday. Okay. Should we move on? I think 30 minutes more. Okay. So we'll 1:15 we'll try and close. Yeah. I'll just take a sip of water. So, has everybody read the GAR in full detail and come? Only 5 sections here. Huh? Or 7. So, we've spoken about international trade, cross-border taxation. What was the main, theme of everything that we spoke about? Right? Can one of you or anybody of you say that? What is the main theme of everything that we spoke about? Just one word. Right? Substance, right? Yeah. So, is substance only relevant when you're determining taxation in a cross-border transaction? No, right? It is relevant in determining any taxation, right? And therefore, you have, so when there was cross-border application of a particular document, they brought in substance through the things that we discussed on principal purpose, limitation on benefits, and so on and so forth. You'll get benefit only if you have substance. You'll get the benefit only if you satisfy the principal purpose test, and so on and so forth, right? Same thing they've imbibed in the domestic law and said that even if there is no treaty, so you have a tax resident of Hong Kong dealing with India, right? There is no treaty between India and Hong Kong, right? Now, even while applying that situation, or you have an Indian entity dealing with another Indian entity, right? There's no question of a treaty because it's domestic, right? Even in those situations, you need to bring in the concept of substance and say that, okay, are the transactions that have been entered into between these entities or this arrangement that has been brought in place between these taxpayers, does it justify or meet the test of substance? And only if it meets that test, we will respect it and consider it for tax purposes. If it does not meet the test,
will ignore it. Right? And this is not something which is new in a way. So again, as I said, as the tax history has evolved from the 17th, 18th century to the 19th century, 20th century, 21st century, you've seen a huge graph of change in this way. Yeah? So you had situations in the past in the 18th century when the House of Lords, the Indian courts as well, said that it's irrelevant. It started from there, saying if the government has put in a law, you have to see what it says legally and decide what tax a subject has to pay. Right? Simple, very clear. Right? The old laws of Duke of Westminster and stuff like that. Very clear. No question of questioning the substance or the intent behind doing something. Yeah. So if you said something was something, you're God and you're right. Okay. From there on, where the courts completely disregarded anything but the form and the legal nature of the transaction and read it with the literal language of the law, we've had changes where they've said that, okay, if you're doing something which is a colorable device, which is not what is uh, as per the law in any other law. So you're something which is not allowed under company law, something which is not allowed under the VAT law, and you're doing, and then you're determining the corporate tax implications of that. Then you will not be done because it's a colorable device. It's not something which is doable in the first place. You've just done you not be attacked by that party, but you've done something which is not doable, and therefore we'll disregard it for tax purposes. And thereafter they said that, okay, now if you've done some series of steps and each one of them individually looks fine because you've done 5 6 steps in deciding or arrive before you do the final step, but if you've done a series of steps which lack commercial substance, right, that each of these had no meaning unless it was followed up by the other steps that was done later on, right? So if the individual steps did not have standalone meaning, then we will disregard all those individual steps and treat you on the net effect of that whole transaction. Yeah. So if, for example, you all know the Dutch treaty says if you transfer shares from one non-resident to the other non-resident, right, you are exempt from tax. Right. So let's say as a Dutch company you own shares in the Indian company. Right. You've invested at maybe 1 million. Today the value is 100 million. You have a 99 million profit on that. You have an Indian buyer. Right. The Indian buyer is ready to buy it at 100 million. If you sell it to the Indian buyer as a Dutch entity, you pay capital gains tax on the 99 million that you make, the profit that you make. But the Dutch treaty says that if there's a non-resident, you sell it to another non-resident, yeah, you're not subject to tax in India. So you decide that as the seller, I will sell to a bank in London. So Citibank in London, for example, I'm just using name, no intent to put that in, but Citibank in London says, I will buy this for 100 million. Or let's say, थोड़ा दया खाता है इंडिया पे बोलता है 95 million I'll buy it for. Okay, so they buy it from the Dutch resident at 95 million. So now the Dutch guy has made a profit of 94 million, 1 million investment, 95 million the sale price. Right? The Dutch treaty says if you sell shares of an Indian company to a non-resident, which is Citibank London, is a non-resident in India, you pay zero tax in India. Right? So you pay tax, you pay zero tax on the 94 million of profit that you make. So from paying tax at 20% on the 99 million, you're paying 0% tax on the 95 million. And then Citibank again sells it to the Indian buyer for 100 million. And says, okay, I've made 5 million of profit, I'll pay tax on the 5 million. Now, is there anything wrong in any of the transaction that has happened? Yeah? Yeah. Is there anything wrong? On the legal form of the transaction, there's nothing wrong. Right? You are entitled to sell it to Citibank. Citibank is a big company worldwide. It could have bought any shares. Yeah. But if you do that in like 1 week, you sell it to Citibank. Citibank sells it to the Indian buyer and says, I'll pay tax on 5 million. The Indian tax authorities will like to accept it. So what will they say? That this series of steps is actually nullifying each other. The purchase by Citibank and the sale by Citibank is nullifying each other. And therefore, what is the effective transaction? You, as in a Netherlands seller, sold it to the Indian buyer for 100 million. That is what we see as the transaction has happened. We are ignoring whatever series of steps you took in Indian, because these series of steps had no commercial meaning at all, had no substance at all. Right? So we'll ignore this. Right? Now, this is not what the LOB says or the principal purpose test says. Right? This is beyond those conditions, and said that we are ignoring the series of steps that you have taken because we think this has no meaning in whatever you ultimate transaction. Your intent was always to sell to the Indian buyer at 100 million. You just sold it to Citibank to be able to save tax on the 94 million that you made. Right? So this is where a GAR comes into picture, because there are specific rules in the treaty, in the domestic law also. I mean, are there any anti-avoidance rules in the domestic law itself? Many, right? 94B is the latest edition. Cyprus was the latest edition. You have 60 to 64, the oldest possible anti-abuse rules that are there in the treaty on clubbing of income. If you just transfer without any substance to a family member or to somebody, that income will get clubbed in your hands, and you will pay at the full rate of 30% and not get a separate slab, different slab, etc., etc. Right? So there are anti-abuse rules in the domestic law as well. In transfer pricing is an anti-abuse law, right? That you have to be rightly pricing the goods that you are, or services that you are doing a trade in, right? So there are many specific anti-avoidance rules on particular types of transactions, or dividend stripping, bonus stripping. There's a specific anti-avoidance rule in the law itself, right? If you do dividend stripping, you are not allowed to take advantage of the short-term loss that arises on that, right? So there are specific rules on specific types of transactions that are taking place. But equally, when you do not, because people are innovative, all of you are great minds here, and you will come up with new ideas and new thoughts. So they need to have a general anti-avoidance rule to pluck that. So as I said, this sale by Dutch entity to Citibank London to the Indian seller is not subject to any specific anti-avoidance rule. Right? But to attack this, because it was something the horse of commercial substance, they had to bring in a general anti-avoidance rule. So that's the whole basic crux of why you need a GAR in the first place. Why the tax authorities need to be employed with a GAR again. So as I said, the history on anti-avoidance has gone, traveled over the years from saying, sorry, we'll ignore it, to saying the courts said, no, we will look at it. The classic decision, if anybody wants to read on this, my favorite decision is 183 ITR on Craven versus White. It's the classical decision on saying how you determine what is a series of steps that should be ignored for determining the final taxation. Right? It's a House of Lords decision. So that's the latest thinking on saying, how do you ignore the intermediate transactions and look at the final transaction. So from there, whether courts were trying to impose a GAR, because there was no provision in the law to say you can have an anti-avoidance regulation in these cases. But the courts themselves started putting in that condition that if we are interpreting, and if we see that you have done some colorable device or you've put artificial steps which has no meaning, then as a court, even if the law doesn't say, we will rule ourselves and say we'll ignore this. So the courts were applying the GAR. So in India, there was always a judicial GAR, meaning the courts had already framed its own view on GAR, on anti-abuse, on anti-avoidance, right? And they themselves were adopting it in many cases. I mean, you have several examples of where it has been adopted. I'll not go into details. But because it was not coded, the courts would have the discretion to apply it the way they want it. So the good thing about having this GAR in the law is now that it is coded, meaning we know what is the law. And the courts will also have to respect this law, because they can't say still today the Supreme Court judges can do anything they want. But at least they'll have some limited discretion when they're looking at a law which reads the way it reads, right? So in a way, I would say that this is always there in the law, because the courts are always bringing it or applying it. It is just now that you have a legislation which deals with it. So it's a legislative GAR as against a judicial GAR that existed earlier, right? So this is one important thing, that I don't see this as a big change that has happened. It is already there, always there. Secondly, I think, how does this work? So what you need to do is first see the three basic tests that are laid down there. So there has to be an arrangement. I mean, any transaction, anything that you're doing, any arrangement, international transaction, domestic transaction, whatever you've done, there has to be an arrangement or a contract or a business transaction. Then there's a tax benefit out of that transaction, because you want to attack it from tax purpose only if you have a tax benefit. So think of it that you had this law which said that, this case where somebody subscribed to shares of a company at a higher than the fair value, because they were 100% owner. You can recollect the case, Shell, right? The Shell decision, which basically had Shell was 100% owner of the Indian company. It had to put in further money. It said, doesn't make sense for me to keep in at 10 rupees or 100 rupees. I'll invest at 1000 rupees. How does it matter? Because I'm the 100% owner of that company, right? Even if I put it 100%, I still own 100% shares, and I get lesser number of shares, but I still get the full shares. And then the tax authority said, no, that the fair value is 10. The company has got 1000 for that 10 rupee share because they subscribed at a higher value from Shell UK. And therefore, I'll tax you on that 990 as a company. Now, that is capital coming into the company. Can you ever tax a capital transaction? Only revenue transactions can be taxed, right? So this was not a revenue receipt. This was a capital receipt. So then you say there is a tax benefit in the GAR. It has to mean that the net effect of whatever you are saying has to be, first of all, taxable. It cannot be in the capital field or something which is not taxable. So only the GAR will apply if there's a tax benefit out of the net, the overall transaction in effect that you have held, and therefore you show that there's a benefit, and now the government has said only if the benefit exceeds 3 crores. So they've kept a minimum threshold of transactions for 3 crores, but that's a separate point. First of all, there has to be a tax benefit. So if you say the net effect of everything is a capital transaction, then sorry, there's no GAR applicable, because there's no tax benefit that has arisen out of that, right? So a tax benefit has to be on a transaction that the tax authority say, this is what I see as a net effect of this, whatever you've done, and this results in a revenue taxable income. If it results in some transaction or net effect which is not a taxable income, then the GAR should not apply. And then the third condition of this is it has to be treated as an impermissible avoidance arrangement. So there's a definition of impermissible. So it has to be treated as impermissible. And we'll leave it at that. We'll look at the definition. Yeah. So if all of these three conditions are satisfied, right, then the tax officer can invoke GAR, and if he wants to do that, he has to follow a process. So we'll look at that process. This is the key slide, and we'll probably not go too much beyond all of this, because as I said, a GAR discussion will take 2 days by itself. But what you need to, each of these relevant parameters is important when you're reading the GAR provisions, right? So it will apply if an arrangement or a part of the arrangement is treated as impermissible by the law. Now, what is impermissible is defined in the law. Okay, so the first of the definition says the main purpose is to obtain a tax benefit. So the only main purpose of that entire events or transactions that you have done was to obtain the tax benefit. So if you can demonstrate, therefore, that while I did obtain a tax benefit, but I had a significant business advantage of doing this, right? Then can the tax authorities apply GAR? No, because the main purpose is not only tax benefit. The main purpose was a tax business advantage. So what is that example? Let's take a case where you have two entities operating in India. One is marketing, shampoos, and the one other is marketing soaps, manufacturing and marketing soaps. Now, clearly there is synergy in selling soaps and shampoos together, right? So you decide. So let's say the entity which was manufacturing and selling shampoos, marketing and selling shampoos, is making profit, and the entity which was marketing and selling soaps is making a loss. They both operate all around India. Everywhere in India they operate. They have operations in many countries, in all the states, etc. Purely domestic, no international, right? You decide that I'll merge these two companies. So when you merge, what happens? The profits of the shampoo will offset the losses of the soap. So effectively you pay zero tax on the merged entity, because now both are into one entity. So tax office say you merge these two entities with the main purpose to get a tax benefit, because otherwise the shampoo entity was making tax payments. This was carrying forward its losses for many years, and it was operating separately. So net net, you are paying 100 of tax, you are paying 0 tax now for the next 5 years. So I think this is a subject to GAR. And is this a benefit that you have got on the tax side? There is no doubt, right? You've got a benefit. You're paying 100, now you're paying 0, right? Clearly. But along with this tax benefit, you had a huge synergy in selling soaps and shampoos together. So going forward, you will show the tax officer, let's see, my marketing spend, which was 6% of sales in both the entities together, has become 4% of sales. I have been able to reach out to many more cities and towns of the country as against being standalone and individually selling soaps and shampoos. Because now I have the same salesman who is carrying the soap and the shampoo together to the same retailer. And therefore, I am benefiting out of this thing on a commercial basis. I'm seeing my profit, that was net profit, both the entities together was 300, has now become 500. Although I'm paying no tax because the 500 is offsetted by the past losses and stuff like that. I'm not paying tax, but the profit has gone up. And if you show that, then the tax authorities cannot challenge you and say that tax was the main purpose of this. There was also a business advantage that you got out of it, and therefore you selected to do it. You went ahead and did that, and therefore this cannot be a subject matter of GAR. So again, as we go through GAR defenses on any transactions, yeah, you will have to see what is the business impact of this happening, and then evaluate it and come to the right answer and say, okay, is this something which is subject to GAR? So the first test is that your main purpose is to obtain a tax benefit or not. You have to say yes or no. If you say no, then you don't go forward. GAR is not applicable straight away. But let's say somebody says no, the main purpose was to obtain a tax benefit. Suppose you reach that conclusion in any particular scenario, right? Then you still have to satisfy one out of these 4 tainted conditions, as we say. So if you're tainted with one of these 4 conditions, then you will be again subjected to GAR. So what are those things? That your transaction is not at arm's length. It's not only about transfer pricing, but it's much beyond transfer pricing as a GAR, because it can characterize transactions and so on and so forth. Transfer pricing generally cannot. So the GAR looks at that, is your transaction not at arm's length? Now, if it is at arm's length, you're not satisfying this condition, right? Is it amounting to an abuse or misuse of law, right? So they had these things like dividend stripping being treated as an abuse or misuse of law, right? You had clubbing provisions were brought in to avoid the misuse of the law by transferring profits to your family members and stuff like that, right? So these are examples of how you abuse or misuse the law, and therefore in any situation you will be come up, your transaction is whether it is abusing the law or not is the question that you will have to answer. Then it says it lacks commercial substance. So we've spoken enough about commercial substance, but also there is a definition in the act itself on what is lacking commercial substance. So which are the arrangements or transactions which will be deemed to lack commercial substance. So there's a deeming fiction in the law itself. Yeah, and again, I've not dealt with it because it's too wide and too difficult to deal with in the next 10 minutes. But it, things like round tripping of funds, you're moving monies around the system between entities, and so on and so forth. Those are clear examples of lacking commercial substance, right? Or it is carried on in means or manners which are not ordinarily employed. So as I said, if you have to sell to the Indian seller, you will generally go and sell your shares. You will not sell it to a banker in London and then they will sell the shares. That's not what is ordinarily done, right? So if you've done something which is out of the ordinary, you will not be able to defend it under the GAR. You are impacted by the tainted condition. So if you have satisfied both these conditions, so the main condition of tax benefit and one of the 4 tainted conditions, you will be questioned under GAR, or you will be subject to GAR effectively, right? And of course, if you are subject to GAR, then what can he do? As I said, he can recharacterize your income, he can ignore the intermediary steps, he can do anything that he said was what was alleged or done by you to avoid taxes, and therefore you can disregard all those things in the middle and tax you on the final net effect of that whatever he's holding. So this is the basic crux of when a GAR will apply. So it is coverage only if it is impermissible arrangement that is there. Then there is grandfathering of existing investments. So what they have said is that if from overseas, like in the Mauritius and the Singapore treaty, they have grandfathered investments. Under GAR also, they have made a provision that if it is investments were made before April 1, 2017, yeah, from a foreign jurisdiction, then you are grandfathered, meaning the GAR cannot apply. So if you sell that investment even in 2025, yeah, you are eligible to the original Mauritius treaty benefits or the Singapore treaty benefits or whatever they are. Right? It's different that the Singapore and the Mauritius treaty itself have changed now. So now if you sell in 2025, you may be subjected to tax in, this thing. If your investment is after April and all that. So that's, but it is under the Indian GAR, your grandfather, because there's a huge hue and cry around this, that how can you tax past transactions, because people took the decision in the past based on the provision of the law that existed at that point in time. And you can't unilaterally impose something which is different, and so on and so forth. So there were arguments around that. Then they've exempted certain specific instruments like the FIIs who do not claim treaty benefits. So you have a US FII investing into the Indian stock market. Yeah, they said you're not subject to GAR. Full stop. Okay, because anyways, if you are not claiming a treaty benefit, means you're paying full tax in India under domestic law. So they didn't want the tax authorities to be able to even to harass some of these people on the pretext of applying a GAR and all that, and therefore they clarified, which was to soothe the nerves of the stock markets. Equally, they've said P-notes, etc., with the offshore derivative instruments through which investments are done in India, which are allowed under SEBI as well, right? You are not subject to GAR because you will not be brought into the GAR net. We spoke about the threshold being tax benefit has to be more than 3 crores. Importantly, the tax benefit is not looked at each taxpayer wise, because typically you will see in a GAR, it is not just one entity doing business with the other entity. You will have many more entities brought into the picture, like a accommodating party as they've defined, somebody who's helping the other party. Just the bank in our example is an accommodating party. He has no purpose or reason to be there in the transaction, but he's just coming in to support the other party, right? So when you look at this benefit of 3 crores, you have to look at it on an aggregate basis for everybody in the system, not on a one-on-one individual basis, right? So the tax benefit definition has to be there. The GAR and the SAR. So we spoke about examples of the specific anti-avoidance rules. The question was that if there is a SAR, why do you need a GAR to apply in that case? We've already provided for, right, that if you're doing dividend stripping, this is the outcome of dividend stripping. Now, why do you need a GAR to, again, question you or challenge you on that? If you have debt which has interest more than 30% of EBITDA, this is disallowed anyways today. Right? Why do you need a GAR to challenge a debt transaction and recharacterize as an equity or whatever? And the answer to that is probably that, so the earlier thinking on this, when the Parthasarathi Som committee had put up its report, etc., and even the finance minister has been on record at that time, and this was the earlier finance minister, that we don't intend to apply GAR where the SAR exists. Okay, so if a SAR exists, it's good enough. We've considered that, we don't want to apply GAR. The Som committee report also supported that view. But in the FAQ that the CBDT came up with on this issue, they have re-looked at this and changed their position and said that the GAR and SAR can coexist, which means that both will apply. Okay, and the rationale that they are putting on the table is that it is not possible for a SAR to envisage all situations. If we come across a situation, we will put in a SAR, like 94B, like clubbing, like dividend stripping. But if tomorrow you start a new way of doing dividend stripping, we can't stop you under the SAR provisions, and therefore we need a GAR provision to cover those cases. So the net effect of this is that a SAR applies only in a particular situation. If that particular situation is there, the outcome will be as per SAR. So I don't think anybody has a doubt or on that. But if that is not covered by that situation, that means that first of all the SAR doesn't apply if it's not covered by that situation. Therefore you can cover it under any other provision. So I don't see a huge dichotomy in what has been worked out, because if a SAR doesn't cover a particular thing, then the SAR doesn't apply to that particular thing, and therefore you look at the GAR. But yes, if a case comes under dividend stripping, you cannot impose all the outcomes of a GAR, because the outcome of that is defined in section 94(7). You don't have to go beyond that, right? So if a case is covered by SAR, exactly, then the outcome is as per the SAR. It cannot be that the outcome of GAR can be impact, because an outcome under GAR can be much more heavier and much more onerous on the taxpayer as compared to what the SAR says, because the GAR has full discretion for the tax officer to redo the way he wants to redo it, recharacterize everything. But a SAR says, okay, if you've done something wrong, this is the outcome, full stop, you're done. Whereas GAR has complete discretion in deciding what you can do and what you cannot do, and so the AO has full discretion. So I think if it gets covered under SAR, you can't do the outcome under GAR, you have to do the outcome under SAR. But if it's not covered under SAR, then of course GAR will apply, is what I would like to sum up on this issue. This is very important, that GAR, the provisions that exist, says that you cannot do or take a tax benefit without a substance. But equally it doesn't tell you that everything you have to do has to pay the maximum tax that you are required to pay. So if there is a counterfactual, as we say, there is a counter way of doing a particular transaction, right? So for example, in our example of soaps and shampoos, one option was to merge the two companies together, you bring together. The other option could have been that one of the entity just bought over under a slum sale the business of the other entity, which would have meant that they would have paid a tax, because if you buy it at a fair value, you would pay tax on that business as capital gains on slum sale. Now, the GAR doesn't say that you had to do a slum sale because you did a merger to avoid tax, whereas a slum sale would have paid the maximum tax. That's not the way you decide on a GAR. For example, we're all in Bombay, and if you're going from Bandra to Nariman Point, you have the option to travel by the sea link, right? And you also have the option to take the normal Bandra Mahim road and go to Nariman Point via Shivaji Park and so on and so forth, right? You see on a particular day, the ceiling is either shut or there's a huge traffic on the ceiling, and it's slow moving because of some accident on the ceiling, etc., and it's going slow. And you decide, I'll not go via the ceiling, and I'll take the normal road. The tax authority will say, you didn't go via the ceiling because otherwise you would have to pay tax to the municipal corporation, which is there in that 75 rupees that you pay. Can they say that? So you have the right to decide what is good for you as a business to do what you want to do. You cannot be forced to take a route which requires you to pay the maximum tax. But whatever you do has to be justified to say this was not only for tax avoidance purposes or tax reduction or optimization purposes, but also gave me a commercial business advantage. So I reached faster from Bandra to Nariman Point because I did not take the sea link. That's why I did not take the sea link, as against to avoid paying the tax going via sea link. So that's the difference that you need to bring in mind, because this is an important part of whatever you will plan and issues that will come across. That is there a counter way of doing something which would have given the same result? And am I supposed to do something which gives me the maximum tax, or am I allowed to plan around it? Because if the tax officer says that you could have done this by a slum sale and said, oh sorry, but I'm not required to pay the highest tax, I will argue that point. I'll say, you can't apply the GAR to me on this point. So that's how this is. Grandfathering, as we said, it applies to investments prior to April 1. Also, if you have invested in convertible preference shares or convertible debentures, and they convert into equity shares in 2020, but you invested before April 1, 2017, then even the equity shares that you get on conversion will be grandfathered. Okay, so it's just a conversion event. Doesn't mean that you've now invested afresh in the equity shares. If the original CCPS or CCDs were invested prior to April 1, 2017, you'll get the benefit of the grandfathering provisions. But that is not applicable in a case of a merger or a demerger and so on and so forth. I think that's very important to note, that even though it's a tax neutral transaction as a merger demerger, if as a Mauritius company you held shares in an Indian company which is now merged with another entity, and you get fresh shares issued on the merger to the Mauritius company, then that happens after April 1, 2017, you will not be grandfathered on those investments. So it's a very important difference that you need to bring in, that on conversion you are, but on a fresh issue of shares upon a corporate event, etc., you are not eligible for this benefit, except for bonus shares. So bonus shares are eligible, but not on merger or demerger or a corporate action that you get any further shares, etc. GAR, so let's say if you have a transaction which is approved by an NCLT or a high court, and the question is whether GAR will apply or not apply in that situation, because the courts have already seen it. And the answer that the CBDT has given in the FAQ is that if the court or the NCLT considered the tax implications, right? So as you probably people who deal with merger demergers here will know that all the notices of a merger or a demerger or any such corporate restructuring event are also sent to the jurisdictional assessing officer, right? So the jurisdictional officer, if he has any questions or doubts on a particular merger or demerger happening, they can put a notice in the court and be heard in the court on that tax issue. Now, it is a different thing that generally they don't do it, but they have the opportunity to do it, and therefore the question will arise, and this is up for debate in the future, that if they did have an opportunity and they did not raise the question at that point in time, right? Can they raise a question later on, 3 years, 5 years later in an assessment, whether whether this merger was done to or is subject to GAR or was done to avoid tax or so on and so forth. So that's the area that will develop in terms of jurisprudence, and we'll see what happens. But currently they've said that if the officer has raised an issue in the court and the judge has dismissed it, then you are clearly home that no GAR can be applied in the future. But if he has not raised the issue and the judge has not dealt with it in his order, then it's an open debate as to whether the GAR can be subsequently applied or not. Yeah. So I think also one of the important thing is that even in a grandfathering or any arrangement, if you have an existing arrangement since last many years, suppose you are paying royalty to a parent entity for the last 10 years. So you have an arrangement since 2008, and that arrangement continues till 2025 for whatever reasons. Now, can the GAR apply to such continuing existing arrangements? And the answer is yes, it can apply, even though the arrangement was before April 1, 2017, in relation to the income that is earned after April 1, 2017. Right? So if there is anything, so it cannot go back till 2008 and reassess or reopen all the past assessments. But from April 1, 2017 onwards, the financial year 17-18, which is the first year of the GAR applicability, it can assess the income for that particular year, even if the arrangement was an existing or an old arrangement. Yeah. So I think these are some of the important things that I thought we'll deal. I think the procedural aspects, you have to go through the panel and there are multiple checks being brought into the system. I mean, you can walk through this process 1, 2, 3, 4. So from the AO, you have to first take approval of commissioner, and if the commissioner approves, you still have to go to the approving panel, and the approving panel has a collegium of a high court judge, a industry expert, and the commissioner. So it's not just the tax officers deciding whether it should be subjected to GAR or not. There is enough checks and balances put in place that genuine cases are not picked up, and only if the approving panel approves, after all the checks that a GAR should be invoked in this case, can the officer take any action against you. So again, they have put in a level of scanning and going through checks and balances before you invoke a GAR. So that's a good thing, because there was a lot of fear that the tax authorities in India can just go about doing anything because the discretion with the officers, which just depends on which side of the bed he got up in the morning. Yeah. So that's it, and thank you. Have any questions? Yeah, but except the question that lunch is served.
Friends, one announcement. On 23rd evening, we are arranging a end of the course dinner. So whereat we will felicitate all our faculties who have spared their time and shared their knowledge with us. You all are invited, but as a mark of your confirmation, please sign the statement kept outside so that we can make appropriate arrangement on 23rd. And today we'll be having the exam at 4:30. The timing will be from 4:30 to 6 o'clock. So, and those who have qualified, I'll announce the names of the 3 or 4 candidates have not qualified by meeting the attendance criteria. So I'll announce at the 4:30 only. So be seated and enjoy your lunch.